Ladies and gentlemen, good day and welcome to ECOSMOBLTY and Hospitality Limited Q3 FY26 earnings conference call. As a reminder, all participants' line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Priyanka Bhagat from Adfactors Investor Relations team. Thank you, and over to you.
Good evening, everyone. A warm welcome to all of you, and thank you for joining us today for Ecos India Mobility and Hospitality Limited's Q3 and 9-month financial year 26 earnings conference call. We truly appreciate your time and continued interest in the company. We are pleased to have with us the senior management team led by our Chairman and Managing Director, Mr. Rajesh Lumba, who will share his perspective on the company's performance for the quarter and the 9 months ended financial year 26. He is joined by our Chief Financial Officer, Mr. Hem Upadhyay, who will take us through the financial highlights. Before we begin, I would like to remind everyone that certain statements made during this call may be forward-looking in nature. These statements are based on current expectations and are subject to risk and uncertainties that could cause actual results to differ materially. With that, I now hand over the call to Mr. Rajesh Lumba for his opening remarks. Over to you, sir.
Thank you, Priyanka. Good evening, and thank you for joining us today for Ecos India Mobility and Hospitality Limited's Q3 and 9-month FY26 earnings conference call. So before we begin, I would like to extend our sincere gratitude to all the participants who have joined our earnings call, and a warm welcome to the ones who have joined us for the first time, and thank you for the investors who have shown continuous engagement and support to Ecos. To begin with a brief overview of the company, as many of you are aware, Ecos is a leading corporate managed mobility solutions provider with a pan-India presence. We offer comprehensive B2B transportation services across two key segments. One is employee transportation services, which we also call ETS, and the other is chauffeur-driven car rentals, or CCR. We currently operate in over 131 cities across India and have a presence in more than 30 countries globally. Our clientele includes many Fortune 500 companies and BSE 500 companies, global capability centers, travel and event management companies, along with fast-growing Indian enterprises and SMEs, as well as B2C customers availing our premium services. These clients rely on Ecos for scalable, safe, and technology-driven mobility solutions. Our strategic focus remains consistent. It is to drive sustainable growth by onboarding new clients, at the same time enhancing wallet share from existing relationships and clients, and expanding our presence across new geographies, both domestically and internationally. With that brief overview, now let me take you through the key highlights of Q3 FY26. As we have reiterated over the past 2 or 3 quarters, we continue to make strategic investments to establish a durable and differentiated position as a technology-driven, globally relevant mobility platform. These initiatives are delivering tangible operational benefits and are shaping the future evolution of a fully digital Ecos with increasing adoption of our end-to-end CCR platform. Currently, more than 21% of CCR bookings from our corporate clients are powered by Ecos Cab Drive Pro, APIs, and customer app platforms. During the quarter, we also launched our direct web booking portal, marking an important milestone in the company's ongoing digital transformation journey. This platform extends the same enterprise-grade reliability and service standards that ECOSMOBLTY is known for among large corporates to individual users and small and medium enterprises, thereby broadening our reach beyond traditional corporate contracts. From a geographical perspective, our business remains well diversified across major Tier 1 and Tier 2 cities, with Bangalore, Delhi, Gurugram, Mumbai, and Hyderabad together contributing 60% of the company's total revenue. Further strengthening our presence, last month we inaugurated our new second office in Bangalore, an important step in deepening our footprint in one of India's most significant enterprise and technology hubs. This expansion aligns with EcoMobility's broader growth strategy of scaling responsibly across key metropolitan markets while continuing to invest in people, tech, and government-led mobility solutions. The new office enhances our ability to deliver reliable, efficient, and future-ready mobility services to enterprise clients in the region. This momentum was further reinforced with the onboarding of 39 new clients during the quarter, many of which are large enterprise clients. So typically, if we talk about such clients involve a higher startup and ramp-up costs, with margin expected to normalize over the next 2 to 3 quarters as operations scale up with these clients. This takes our active client base to 1,734, a growth of 34% compared to Q3 FY25. These additions reflect the industry-wide shift towards organized and reliable mobility partners. Client retention remains strong, with 55% of our first 9 months revenue contributed by clients associated with ECOS for over 5 years. This underscores the strength and longevity of our client relationships. Our fleet capacity expanded to over 19,000 vehicles, including 997 owned units. This enables a calibrated asset-light approach, ensuring capital efficiency while selectively deploying own fleets. Total trip volumes for first 9 months stood at 3.84 million, out of which 1.3 million trips were undertaken in Q3 itself, representing a healthy growth of 31.29% compared to Q3 FY25. Now, this reflects sustained enterprise demand and underscores our ability to scale rapidly and efficiently across high-value mobility segments. Turning very briefly to our financial performance, ECOS delivered resilient revenue growth of 22.8% on a consolidated basis year-on-year in Q3 FY26. This has been driven by strong performance across both employee transportation and chauffeur-driven car rental segments. This growth was supported by higher trip volumes and an improved premium mix during the quarter in the CCR segment. Encouragingly, operating cash flows remained aligned with our EBITDA, and working capital days stayed stable despite the higher scale of operations. Now, this reflects truly disciplined execution and a strong cash flow management. To conclude, we remain focused on strengthening our market position, garnering more market share in a very highly fragmented industry, which we believe will drive sustained top-line growth over the next medium to long term. While margins may remain moderated in the near term as we continue to invest in technology and digital solutions and our people, including leadership talent and our chauffeurs, these investments are critical to building a scalable and resilient platform. While the current phase reflects calibrated investments to accelerate the scale of our business and the growth, we believe we are approaching an inflection point where operating leverage, the premium mix expansion, and efficiencies of scale will begin to reflect more meaningfully in the margins. We are confident that this phase will mark an important milestone in ECO's growth journey. With that, I will hand it over to our CFO, Mr. Hem Upadhyay. Thank you, and over to you, Hem.
Thank you, sir, and good evening, everyone. Now, I will take you through our financial performance for the quarter and 9-month ended December 2025, and provide some context around the key movements. During Q3 FY26, we reported revenue of rupees 2060.71 million, which representing 22.48% year-on-year increase. This growth was driven by higher activity level across both the CCR and ETS segments, supported by sustained enterprise demand and better utilization across the fleet. We continue to see healthy traction from our corporate clients, which is encouraging for the medium terms. Our EBITDA for quarter stood at rupees 233.55 million, reflecting a year-on-year growth of 8.05%. Operating leverage from higher scale supported profitability. However, margins were impacted by higher variable and vendor-linked costs associated with servicing incremental volume and onboarding large enterprises accounts. As a result, EBITDA margin for quarter was 11.33% compared to 12.85% in Q3 FY25. This moderation reflects near-term cost pressure linked to growth-related investment and drive for higher market share. We have already initiated price adjustments, vendor rationalization, and cost efficiency measures, which I expect will support margin improvement as these actions flow through over the coming quarters. Profit after tax for Q3 FY26 stood at rupees 139.43 million, registering a 9.2% year-on-year increase, despite higher depreciation following fleet addition made to support the growth. Turning to 9-month performance, revenue from operation for 9-month FY26 stood at 6013.98 million, up by 26.15 year-on-year, reflecting sustained momentum across both business segments and continued expansion of our operational footprint. EBITDA for 9-month period was 697.76 million, a 5.85 year-on-year increase, with EBITDA margin of 11.60% as compared to 13.83 last year. The margin movement over period reflect higher manpower deployment, fleet expansion, and certain non-recurring provisions incurred. Profit after tax for 9 months stood at 418.40 million, broadly stable compared to previous year. Overall, I am encouraged by strength for our growth and the resilience of our operating model and the discipline with which we are investing for scale. Our balance sheet remains healthy, demand visibility is strong, and as operating leverage improves, I am confident in our ability to deliver sustainable growth with improving profitability. For that, I will now open the floor for questions. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Jainam Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity. Congratulations for the strong top line growth. My first question is related to the top line for the fourth quarter. As we have guided for around 17 to 20% kind of growth for the full year, we are already at 26% kind of a growth in the 9 months. How has been the momentum in the January month and overall 4Q, how we are expecting? Thank you for the question, Janam. And I guess it's been going better than what we expected so far. And we hope for the same trends to continue. But over the long term, our guidance remains between the 15 to 20% growth. At the same time, we hope that we are able to exceed these our own targets.
Got it, sir. Got it. And if you can just give me the number in terms of how has been the contribution of the CCR and ETS segment for this particular quarter?
So if you look at CCR in this quarter, CCR grew by almost 30%, and ETS grew by almost 24% in this quarter. And if you look at the total revenues, CCR revenue would stand at around 43%, while ETS would be around 57% of the total.
Got it, sir. Now coming to the margin part. So basically, margin, of course, for last 2 quarters, there has been some provisioning which has impacted our margin. But how about this particular quarter? Like, what could be the reason which has impacted our gross margins and not only the EBITDA margin? Because our gross margins tend to be in the 27-28% range. Now it has eventually reduced to 26 and 27% range. Any specific one-offs or anything that you can call out for the same?
No, there's not too many one-offs. It's just some provisions have been taken on account of the new labor code of maybe around 75 to 80 lakhs. Sorry, labor only 15 lakhs. Okay. Sorry, for around 15 lakhs. So there are no very large one-offs that have happened in this.
Okay, sir. So, of course, we were guiding the margin range earlier between 13 to 15%, and you already said that margin might remain moderated in the near term. Any specific range that you would like to call out, or this is the new normal that we can take for at least for 2-3 quarters?
So typically in the third quarter, even if you look at the previous quarters, the margins have been a little compressed because also, our top line got affected because of a large number of public holidays, the gap in North India, which carried on. But there is no, and we also onboarded a lot of new enterprise clients. And what happens with these enterprise clients is, initially, during the scale up and the ramp up, the costs are typically much higher, and it takes 2 or 3 quarters for the margins to normalize.
Got it. And sir, what would be the capex number for the 9 months FY26?
Around 26 crores.
So it's around 26 crores, sir, as of now.
Okay, and what would be the target for full year and for the 27?
Yeah, it should be for 25, 26, it will be the full month will be around 32 crores, not more than around 32 crores.
Got it. If you see, sir, our overall fleet size, even the top line and everything, things have changed drastically over the last 2-3 years. The only thing which has not changed is our absolute EBITDA in the bottom line. So just wanted to check from your part that this all investments that we are doing, maybe let's say the price hike has not been that great over a bit of time. Is it the competitive intensity one of the core reasons for the, let's say, diluting of the margin, or it is just more on the investment part that we are doing for the future revenues?
That is always been there, sir. The competitive intensity has always been there. But our main focus right now is on garnering more market share. And when we're doing that, it takes a while for the margins to actually stabilize. And that's the aggression in garnering market share is also being reflected in the above expectation growth in the top lines.
Got it, sir. Yeah, as of now, that's it from my side. If I have anything, I'll join again. Thank you so much.
Thank you, sir.
Thank you. The next question is from the line of Senthil Kumar from Joindre Capital Services Limited. Please go ahead.
Thank you for the opportunity. Am I audible?
Yes.
Yeah. I have 2 questions. First one, could you please quantify the provision related to the labor code?
For till this month, we have taken the provision of 15 lakh rupees only till now. 15 lakh rupees.
Okay, for Q3. Okay. So will this provision continue? Yeah. Will this provision continue in the coming quarters as we increase in the number of owned fleets, number of employees, number of laborers?
No, the continuity is just like we will take the actual valuation so that routine incremental as per the joining period increase, that will only come, but not any specific or any exceptional numbers will come after.
Oh, okay. See, in this quarter, now the employee cost is increased from 15.84 crores to 22.87 crores, which is about a 44%. But we have only given a provision of 15 lakhs. Could you justify what is the reason for it, that surge in employee costs?
No. The employee cost, which period you are comparing, that last 9 month 25 and 9 month 26, right?
No, I am talking about Q3 FY26 against the Q3 this quarter.
So these labor law which you are talking about is the outsourced offers which we have for our own vehicles. As far as our own payroll employee are concerned, we are adequately providing those gratuity and leave request liability and as a routine.
And if you look at our the costs increase in the HR costs, it's reflected in the fact that we have 258 odd more people on our roles in terms of executives, and also there's the yearly increment that had happened. So if you look at the last 3 quarters, the HR costs have been stable across every quarter.
Okay. And secondly, could you please clarify the reason for this 29% surge in depreciation during this quarter? Depreciation cost.
Your voice is not clear.
Can you clarify the reason for the 29% increase in depreciation this quarter, 7.38 against the 5.7 crores?
That's because we have added around 250 more cars in the first 9 months, which are both for fleet increase and for replacement of old cars.
Okay. That's it from my side, Alfa. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Jigar Jani from Nuvama PCG Research. Please go ahead.
Yeah, hi. Thanks for taking my question and great set of numbers on the growth side. My question is more on the margin. So if you look at the mix, it has changed more in favor of CCR this quarter, and we have seen that movement over the last 3 quarters playing out. But if I look at CCR, generally is a higher margin business from what I understand overall in terms of take rate. So what kind of, if you could point out on absolute terms, what kind of investments have gone into acquiring this new clients that you are mentioning in the quarter, because then we'll be able to get a sense of what we should look at as an adjusted EBITDA margin if normal course of business would have been.
Yes.
And also, if I could squeeze in one more. Yeah. And if you could guide, I think previous participants asked for margin guidance also. You said next couple of quarters probably margin will remain subdued, but in the PPT, in your commentary, you have mentioned that you are taking some price hikes and some vendor consolidation measures also, which might also help in terms of improving margins. So how does both of these play out? If you could just give us some kind of guidance both for fourth quarter as well as next year, that would be helpful. Thanks.
Yeah, sure. So the increase in the top line of the business, especially with the new clients that have been added on or certain accounts that we get renewed, it comes with in the short term margin pressure, wherein it takes, because our main focus at that point in time is to ramp up our supply and ensure that a continuity of service and as also the growth of the wallet share of the client. It takes a few months for all of that to stabilize and for us to, make that result in an increase in the margins of what we are paying from basis of what we are paying the vendors. So if you look at it, there's a 30% increase in CCR this quarter. There was a 40% plus increase in CCR the last quarter. So the way the revenues have been going up, we also have to make the rationalize vendors, and there is always a lag between the revenues going on and rationalizing our vendor payments. So that's always been the case historically also.
I understood, sir, but from what I remember with our conversations in the past, we usually operate at 60% kind of utilization on our fleet. So we actually have significant capacity that is free to cater to any ramp up in demand per se. So just to understand, is it that you are incentivizing vendors to give supply to you, and which is why the vendor payments are higher and the gross margins are lower? And I just wanted to figure out what kind of impact this would be, maybe 50 bits, 100 bits, a ballpark figure would help, because this would help us model what kind of improvement can we expect over the next couple of quarters or next year.
So the team is working on that same jiggle, and it takes a few months for the margins actually to stabilize. Okay? Of course, there is competitive pressures also, which are there in the market. Currently, if you look at the fleet utilization, yes, it may be around 60%, but the rest of the 40%, which we're currently using for as fringe supply or as supply to be used during peak, when we aggregate that as a permanent supply within the system, it takes a little time for the same supply to stabilize in the system. And that time taken also, after that is done, we start rationalizing the margins with our vendors.
Understood. And on the growth side, broadly, you're guiding for 15 to 20% as a structural model. But given that you are adding clients and the growth has been very strong and wallet share also will go up, would it be fair to assume that it will be near the upper end of the band sometime in FY27? I know probably from a medium term it will normalize to mid-range or lower end, but at least for the near term, can we expect this momentum to sustain?
I think we have a pretty good funnel and a pipeline, and of course, all this will depend on how well the sales organization is able to close out the contracts and get the new business in. But between 15 to 20%, we are fairly confident.
Understood. And just lastly, on data keeping wise, how much would be the cash and investments on our books now?
So currently we have 120 crore plus in as a cash equivalent in our books.
Okay. And sir, lastly, just to confirm, there is a AI summit that is happening in Delhi. Are we associated with that event in any shape or form?
Please come again. Actually, your voice is not clear.
Yeah, I was asking that there is a AI summit that is likely to happen in Delhi. It's a big event. Are we a vendor for that event?
AI event. No, but we are vendors of many such events, and so all I can say is business is good. Yeah.
Okay. Thank you so much for your answers. And
thank you.
Thank you.
Thank you. The next question is from the line of Dixit Doshi from Whitestone Financial Advisors. Please go ahead.
Yeah, thanks for the opportunity. So first question is on the margins only. So obviously we were guiding at 13 to 14%, but we have fallen to 11.3% this quarter. So one of the reason I notice is because of the jump in the the employee cost. So for 9 months, the employee cost has gone up by 36%. So from last 3 quarters, the run rate is maintained at around 20 to 21 crore. So going forward in the next year, considering whatever hiring you are doing, will the growth in the employee cost will be higher than the revenue growth, or it will be lower than the revenue growth?
I think it should be in line with the revenue growth. And to answer your first question, a statement of the margins. If you look at the F9 numbers, excluding the non-recurring provisions that we have taken place, you will see that the underlying EBITDA trend remains stable also.
Okay. But this quarter, it is almost like, because if we see Q3 to Q2 also, even if I remove the 5 crore which we have taken the provision in the Q2, the EBITDA is almost absolute terms is flat. So I think
Yes, so the total non-recurring would be around 8 crores because taken in Q1 also. Some part of that was taken in Q1 and some part was taken in Q2.
No, what I am saying is that in Q2, we have taken the 5 crore provision, right? In Q3, that provision is no more there.
No.
Despite that, our EBITDA is in absolute term is flat for this quarter.
Yes.
Yeah. So one of the reason is the gross margin pressure. So if you can elaborate how the competition is there, and is there a possibility to improve the gross margin in near term?
You see, competition is there, but that is also the opportunity because the competition is so fragmented. And that the opportunity is what we are, working hard to encash on, to consolidate this fragmented business into a professional and organized market, wherein we also feel that our clients are now much more open to that, seeing our success at delivering this in so many clients in the recent past, and which is where we are concentrating to make sure that we are able to, increase our market share at the fastest.
Okay. And one more question was on the ETS business side. So recently, Uber has announced the entry into the ETS market. So what are your thoughts in terms of competition? Because these guys have the big pockets and the habit of making losses in the initial years to scale up the business. So how do you see their entry into the ETS?
So we welcome all competition, especially in the organized segment, because the unorganized market is so huge that the more number of players who are touting their credibility to convert the unorganized to organized only helps the organized part of the market, because more clients would be more open to dealing with organized players instead of the unorganized players. So we wish all our competitors well, and definitely a growing unorganized to organized market would invite more number of players, and there should be. Why not?
But do you foresee any pricing pressure because of this? Because in terms of gross margin?
Prices move in a band only. Prices move in a band within the industry. I will not be able to comment on what their strategy will be into this. But typically what we've seen is prices are already very competitive, and they move in a certain band, especially in the employee transportation business. So we don't foresee any kind of bleeding kind of competition coming in over here, because for a client, more important than just the price is also the credibility, the ability to deliver operationally, to ability to deliver predictably with the same standard of service, 365 days a year. So they have a different expectation than a typical B2C market.
Okay. And last thing, this quarter, obviously, there was a drop in the margin to almost 11.5%. For FY27, do you feel that we can come back to that 13%, or you feel that it may take longer?
No, I think in the long term, mid to long term, our guidance remains the same of between 13 to 15%. And we should be able to recover our margins over the next few quarters.
Okay. So you don't expect further reduction in in the margins. Gradually, it should improve only.
No. So I think there's an inflection point, wherein all the efficiencies of scale, of the operating leverages, all that starts to kick.
Okay. Okay. That's it from my side.
Sure.
Thank you. The next question is from the line of Hardik from HSS AMC. Please go ahead.
Hello. Thank you for the opportunity. I just had a couple of questions. First of all, I'm just a bit new to the coverage of the company, and I just wanted to understand the margin profile difference between the chauffeur-driven side of things and the ETS.
Yeah. So typically, ETS has a lesser margin profile as compared to chauffeur-driven. But what we are able to finally present is a kind of a blended margin, which you see on our financials.
Right. And Rajeshji, you had mentioned that ECOSMOBILTY has exposure to 30 plus countries. So I just wanted to understand, is there any currency exposure to it as well, or the contracts are hedged in the Forex domain?
It's very, very minimal. There's because our business that happens internationally is very less. So there is no currency risk per se. Typically, we also get paid in advance for such bookings, which we execute internationally.
All right. And just one last bit. I just wanted to understand ECO's approach towards the current GCC boom happening in India. Are we there bound to capture that side of industry as well?
Yes, a very large number of new clients that are getting acquired are GCC clients, and definitely this is an inherent need in every GCC that scales up, let's say over 500 odd employees, that they need a secure, safe, and compliant transportation service to ensure that 365 days a year the employees can have a good experience of commute from home to office and back to home.
Okay, fair enough. And sorry, just two more questions. So one was ECO's banking on changing the industry from like a fragmented landscape to a more organized sector. So I just wanted to understand, before we onboard a client, do we have a screening criteria that an entity should have X number of employees, or is it just open to all?
No, of course. Our clients, if you look at the quality of our revenues, I think they're the best than in any industry that you can find. Most of the clients are either multinationals or they are
right.
large or mid-size Indian corporates, or or wealthy individuals as part of the B2C, because we offer only a premium service to them. So that also then gets reflected in our bad debts, which is negligible, and our DSO, which is very, very stable over the past so many years.
Right. Thank you. And Rajesh, one last question. Since we are sitting on healthy cash in the bank, are we looking at any inorganic growth opportunities in terms of M&A?
Yes, we are constantly looking at the opportunities. Unfortunately, we have not been able to put our finger on something right now, till now.
Okay. All right. Thank you for answering my questions, and all the best for the future, sir.
Thank you.
Thank you. The next question is from the line of Siddhi from Aditya Birla Money. Please go ahead.
Hi, am I audible?
Yes, please.
Yeah. So my first question is, what specific operational capabilities does ECOS have currently that a well-funded tech platform like Rootmatic or Movement Sync cannot replicate in 2 to 3 years?
I'm sorry, what? Can you just repeat the first part of the question?
Yeah, I want to ask that what specific operational capabilities does ECOS have currently that a well-funded tech platform like Rootmatic or Movement Sync cannot replicate in 2 to 3 years?
So, operational capabilities are made up of, an ingrained knowledge and culture developed over the years. It has to translate into service delivery at the last mile, every rental out of the millions of rentals that we do. It comes from, the capability of our people. It comes from the rigor and resilience of our processes. And our deep knowledge of the business as a whole. And competition has been there, both tech and non-tech has been there for many, many years. And in spite of that, Eco is the leader, and I think that says it all.
Yeah, surely. And under what situation do you prefer owning vehicle instead of outsourcing? Like over the long term,
I'm sorry. Can you repeat? Your voice is actually breaking. Can you just repeat the question again?
Yeah. Under what situation do you prefer owning vehicles instead of outsourcing? And over the long term, do you see own fleet staying under 10% of total or rising materially?
So yeah, we will, our philosophy and model is asset light, and we intend to keep it that way only. And there are a lot of strategic considerations that go into before we decide where we have to selectively put in our own fleet.
Yeah, fair. And when do you say large corporate are consolidating vendors? What are the key decision drivers for them? Price, compliance, tech integration, or execution reliability?
So I guess the value that the partner brings in is a combination of a lot of factors, and you mentioned tech, and you mentioned tech in another question also. Tech is an enabler, right? And tech does not mean that you would be able to deliver operations, because tech is also a tool of audit for these clients. So many clients also consider that the tech and the operations should not be with one company because it leads to a conflict of interest, right? So typically, most of our clients have tech as we study the client, and then we recommend which this client's requirements, which is the best tech that suits that particular client as per their needs.
Yeah. Okay, that's from my side.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Swecha Jain from ANS Wealth. Please go ahead.
Hi, sir. Thanks for giving this opportunity. Sir, I've been hearing, previous participants' questions on margins, and I've also been hearing your answer on margin. So I still want some clarification on the margin, because, I've heard you saying that, margins will remain under pressure, but I've also heard you guiding that margins will come back to 13 to 15%, and, there is an inflection point. But all I wanted to understand was, sir, if our strategy is to acquire, bigger clients, and as you have stated that, whenever you acquire bigger clients, there is a hit that you have to take on the cost, on the margins, and then there is a,
vendor rationalization, and you have to bear certain costs which impacts your gross margins or your EBITDA margins. So if that is what we're going to do even going ahead, I really want to understand, how do we expect these margins to go back? And, in terms of inflection point, what is our inflection point, either in terms of revenue, in terms of, number of big clients that we want to achieve? So, what do we as management think that, our company is at that inflection point? So that is my first question. And once you answer this, I'll ask my second question, sir.
Yeah. So we feel as a company that inflection point wherein the true operating leverages kick in would be anywhere between 1,000 to 1,200 crore top line revenue, and which would also translate into a certain number of trips and revenues at the city level, as per whatever modeling that we have done. Also, yes, it's right that when we take on new clients, it does result in a high cost, for that client for a few months till the operation stabilizes.
Right. So this phenomena will repeat every quarter, right? So then the margins will be impacted every quarter.
No, but
right?
we are also seeing a higher premiumization in our CCR segment, which should offset the blend margin. And end of the day, if we want to, what we see and over the last few quarters, we've seen the growth, the unbridled growth of the GCCs in India, and even the growth within our existing clients. We feel it is right time right now to go all out and capture market share.
Okay.
Because the lifetime value of these contracts for us is very high, and definitely the margins can be rationalized over time.
Okay. And so my second question was, sir, with regards to our write-offs that we had in the past, just wanted to understand, is there any more write-offs that we are expecting, or whatever we had to do, we are done with the write-offs?
Yeah, that's done in the second quarter. We don't expect any more write-offs.
Okay. Thank you, sir. Really appreciate it. Thanks.
Thank you. The next question is from the line of Harsh from NV Alpha. Please go ahead.
Hi, sir. Thank you for the opportunity. All of our questions are answered by the previous participants. Thank you.
Thank you. The next question is from the line of Mohammad Sufyan Lakrawala from Dinero Capserve. Please go ahead.
Hi, sir. This is Divyesh Mehta here. I had one simple question for our business. So, sir, when we see a service offering as on date, we do the catering to GCCs, ITs, manufacturing, everyone in terms of industry. Can you help me to understand what is the kind of a revenue breakup from all these industries as on date?
I don't have that handy with me right now. Sorry.
No, why I ask this question, sir? Why I ask this question? Because the acquisition cost for all these new clients was quite high, and which is being reflected into the GP margins also in the last quarter numbers. So I just wanted to understand that when we talk about the higher acquisition cost, so if these clients are mainly GCCs, then this will be surely adding to our revenue for next 6-7 years. So if that proportion in terms of sales is higher, then this gives us an additional advantage in terms of visibility of revenue.
So all our contracts are long-term contracts only.
Yeah,
that's for sure. And as we have seen, and proven the stickiness of our client, even beyond the initial contract period of 3 to 4 years, wherein most of the clients find our services satisfactory enough to keep renewing our contracts. So it stretches much more than that.
Okay. Okay. And sir, second thing is like when we see our operationally cash flow of a company, our profits, our operational cash flows are always higher in terms of numbers compared to our net profit, what we post. So my question over here was like on the depreciation. So like this year you have already given the number in terms of CapEx also, that you have spent around 26 crore CapEx for 9 months, and another 4 crore is expected in the last quarter of the financial year. So you have already bought around 250 new cars over here. But what is the depreciation cycle which we take over here, and how do we see a life of a vehicle which is there with us?
So we typically look at a 5-year life cycle for these cars. At the end of 5 years, we look at the cars, condition once again. If they are fit, then we can drive them for another 1, 2, or 3 years. If not, then they're sold off.
Okay. So why I ask you this question is like, sir, the depreciation is a real depreciation in our business. The other businesses, this is considered kind of a free cash flow for the company, where you add the depreciation to the PAT, and then the people see that this is a genuine cash flow which is coming into the company. So in our business, the life of the vehicle is very important to get understood by the investors, to have a visibility where your assets are projecting your revenue for at least 6 to 7 years.
I'm sorry, I didn't get the last part of the question.
I'm saying in our business, sir, it is very important that at what pace our asset is getting depreciated, like our cars. If you have a visibility like 6, 7 years we are talking about, so this capex cycle will be on the consistent basis every year. But at the same time, there will be never a big capex which will be coming at any part of the business cycle.
No, yeah, correct.
Yeah, so that's what I wanted to understand. Anyways, sir, thank you. Thanks a lot, sir.
Thank you so much.
Thank you. The next question is from the line of Viraj Mithani from Jupiter Financial. Please go ahead.
Thank you for the opportunity, sir. Am I audible?
Yes, sir. Yes.
Yeah, so my first question is regarding clarification. We talk about 15 to 20% growth. So that would be the same, the PAT margin of 10 to 12% will be maintained or be bit lower?
Can you just repeat the first part of the question?
You said we grow at 15 to 20% range. So
right.
Going forward, the PAT margins will be maintained in range of 10 to 12%, which has been there traditionally, or will be going lower than that?
No, so our PAT guidance has always been between 8.5 to 10 odd %, not 10 to 12%. And in terms of EBITDA, we are looking at anywhere between 13 to 15% in the mid to long term.
Okay, and can you give a bit more color on GCC, like how many customers do you have and what kind of growth rate do we expect there?
I'm sorry, repeat?
Can you give more color on GCC?
There's some background noise coming
in.
There's some background noise coming in.
Is it clear now?
Hello? No. Can you just speak again?
Yeah, now it's clear?
No. Maybe from somebody else's phone something's coming in. Anyway.
Viraj, there's some disturbance in your line.
Okay, just a second. Hold on. Now is it clear?
Yes. Okay, can you just go ahead? I'll try and hear.
Yeah, I just want to know more color on GCC. I mean, how many customers we have acquired and what growth rate do we see?
So last quarter we acquired around 39 new customers, which brings the total customers acquired in the first 9 months to around 160 odd customers. The growth that we have been able to deliver in the last first 9 months has been around 26 odd %, as compared to the last F9.
I want to say respect of Global Capability Center, GCC, we're talking about.
So what do you know about GCCs? I'm sorry.
How many customers do you have in GCCs and what growth rate do we see in this segment?
How many customers do we have in GCCs? I think we'll give that information to Priyanka and she can provide it to you post the call. I don't have it exactly with me right now.
Okay, and what growth rate do we expect in this sector, in this segment, sir?
In GCCs?
Yes.
So we do not look at it that way, that all the growth, how much would come from GCC or we're looking at our marketing and growth on a holistic basis, wherein we have a certain profile of customers that we target and aspire to acquire, and we then strategize and execute as per that. So typically, yes, GCCs are more right now because of so many new GCCs are opening up in India. But beyond that also, there are other multinationals, manufacturing companies, consultancies, large Indian companies, R&D centers, etc. So many are there, who we are constantly targeting and acquiring.
And so the international business we do, how does it work? We tie up with some operator outside or?
I'm sorry, yeah. Internationally, we have tie-ups with our vendors overseas. Yes.
Okay. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Simoni Sanghvi from Prospero Tree. Please go ahead. Simoni, you can go ahead.
Hello, am I audible? Hello.
Yes.
Thanks. Sir, recently government has launched the Bharat Taxi. So is there any threat to our business because of the Bharat Taxi business?
No. That is ride hailing, and ride hailing has been around for more than 13, 14 years. We don't see that as a threat. Our business model is different, where we are a B2B mobility solutions provider to corporates and SMEs across India.
Yes. So because of the difference of business model, you don't think there will be any threat to the eco? Is it correct, sir?
No. Beyond us, of course, there is similarity that we both give a car and a driver. But beyond that, there is so much more that our customers demand, that's where our business has been modeled on.
Because they are adopting the cooperative model, and the profit will go to the driver or something like that. We have read in the press. So more and more number will be the car owners will attach to their Bharat Taxi. Is there because we are thinking that we might have a lesser number of the drivers or the taxi attached to our business. Will it impact our business? That's why I am repeating my question.
So we have been through various phases in which, over the last 15 years, wherein ride-hailing companies also were giving incentives and all that was happening. But we have still managed to retain all our supply and, in fact, grown even better than before. What happens is when new ride-hailing services or new competitor comes in or a new concept comes in, it also helps in expanding the size of the market, which at the end of the day benefits all the stakeholders in that market.
Yeah. And sir, in Q1 and Q2, the company has making some provision for the doubtful debt around 1.97 crore in the Q1 and 5.94 crore for the Q2. And in Q3, there may be. Is there any provision in the Q3 or there will be no provision? There is no provision.
No. We don't have any more doubtful debts, and that also we are going to try and get the money back.
So that's okay. That's fine. But so why there is a PBT is lower than the Q2 in spite of there is no provision. It's a 5.94 crore. It is around 6 crore rupees of the provision made in the Q2. So naturally, our profit must have gone.
If you look at this quarter historically also, even the last year also, if you look at it, it's always been a little more subdued in terms of the margins. And like I had explained on the call to another question, there are certain costs in terms of our vendor costs and the costs which went up and go up in the quarter especially when we are acquiring new large clients. So the initial costs of ramping up and servicing those clients are on the higher side, which stabilize over a period of time. So we hope to see that stabilize over the next few quarters.
So that cost was the one-time cost in the quarter three, and it will be some more cost will be accounted in the quarter four also.
It depends on the specifics of how we have to scale up and how fast we have to scale up in certain contracts. So sometimes it may be there, but we don't feel that it will be a regular occurrence. And we are making certain strategies around it, how we can avoid that.
Sir, last question. So there is for the 9 months, there was a revenue growth. In this quarter also, there is a revenue growth on a YOY basis. But in profit terms, suppose we come by, the PBT is around 57 crore rupees in the last FY25 as well as in the current year also. The PBT level is 57 crore rupees. The revenue has grown from the 476 crore to 601 crore rupees. So there is naturally some operating leverage must be generated or some more margin. Even though at the same margin level, the absolute number must have increased. It's a 57 crore rupees. So what are the key reasons for not growing in the no growth in the PBT?
So if you look at the numbers, if you exclude the non-recurring expenses or the provisions that we have taken, you will find that EBITDA is more of around the 13% range rather than the 11% range.
But I'm talking about the PBT number because ultimately it is the shareholder will gain from the PAT number, and the PBT is 57 crore rupees. Our revenue increased by around say 22 to 23% in the first 9 months of the current year. But profit number, the PBT remains the same, 57 crore rupees. So is there any... Can we exclude the 8 crore rupees of the provision which you have made in the quarter 1 and quarter 2, and we add that, it comes to the 64 crore rupees, around 65 crore rupees. So in this quarter, there is no provision, then also the profit has not grown. So when we see the profit growth along with the revenue growth, it's because any increase in the revenue must result into the profit growth. It is not happening to our company.
So as said, this is Enupadhyay by Rajesh sir, that there is some operating cost things which is a little on the high side. If you talk about the 9-month comparison for both the period 25-26, so our PBT was 11.7% in FY25, and considering that one-time impact of the bad debts, it was 9.32%. If we remove that impact, so this will be around the same level, the PBT which we have in FY25, right? And during this period also, the employee cost, like we added around more than 250 employee to increase the strength and the visibility of the company to provide the better services. So that is also the factor. And going forward, this employee cost will turn out into revenue, and that overall margin should be the improve in that way.
So can we expect that the now onwards the
Sorry to interrupt you, sir. Sorry to interrupt you, sir. Can you please rejoin the question queue? Thank you. The next question is from the line of Janam Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity again. So my question is related to the provision that we created over the last 2 quarters. What is the status over there? Like, are we going to receive the money in the near term, or it is going to take time? Like, what's the current status, and when we are expecting the money to come in our P&L eventually?
So we are taking the legal action for recovery of that money. So I think that should take a year to 18 months for the legal process to be concluded.
Got it, sir. And the client for which we would have provided for the provision, is this the client which is also contributing the revenue as of now, or it is all done and dusted with that client?
No, so it's a very highly credible client. There seems to be an internal process issue for them, and we hope to recover this money. And it is an existing client.
So we are receiving the money from them?
Yes. For all other things, yes, we are receiving the money.
Got it, sir. Yeah. Thank you so much.
Thank you. Ladies and gentlemen, you are requested to restrict your question to 1 per participant. The next question is from the line of Vaidik Bafna from Monarch Networth Capital. Please go ahead.
Good evening, sir. Congratulations on the good top-line growth. I joined the call late. I just wanted to understand what would be our mix between the CCR and the ETS division in terms of revenue.
43 and 57. 43 is CCR.
Thank you.
Yeah.
Ladies and gentlemen, due to time constraint, that was the last question. I would now like to hand the conference over to Mr. Rajesh Lumba for closing comments. Over to you, sir.
Thank you. Thank you to all our investors, analysts, partners, and all stakeholders for their continued trust and support. It matters a lot. Your confidence in ECOS motivates us to remain disciplined in execution and committed to creating a long-term sustainable value for the company. Thank you very much.
Thank you. On behalf of ECOSMOBILITY and Hospitality Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.